You've been warned. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story out there, dumping everything. And I want you to understand something in the U.S. economy just snapped, which is why executives at some of America's largest corporations are unloading shares at an even faster pace as they want to get out on the top before the word gets out of what just happened. I'm going to show you what they're afraid of and why it suggests that the U.S. economy now is a mere months away from a recession. Let's go to Bloomberg, where he picked today's story up with a headline: Is Bezos Zuckerberg leaked Magnificent Seven insider stock sales as they're now boosting their exit plan as they want to sell at the top because they all understand that pigs get fat and hogs get slaughtered. No one can time the top of the stock market perfectly, and it certainly looks pretty frothy right now. But if indeed we're at the bottom end of a big raging bull market and the economy was going to experience a soft landing or no landing scenario, then these executives, while they still would likely sell some shares, they would not be accelerating their exit plan. And we can see it all in the back of corporate share buybacks because that is the wheels that grease the exit plan for executives and board members. That's what they were designed to do. And why do they want out? Well, something major now has shifted and is telling us where the path of the U.S. economy is headed is not pretty. And put all the insider transactions together and you feel they're calling a bit of the top of the market. And what has changed here is investor sentiment as everyone has crammed back into the Magnificent Seven. They're chasing it higher in a big way. But what they're missing, well, is the missing piece of the puzzle behind the inexplicable strength of the U.S. consumer, which is now looking at potentially $700 billion in phantom debt. This from Zero Hedge. We talked about consumer credit yesterday, but one thing we didn't talk about was the big elephant in the room, which revealed that the amount of credit card debt across the U.S. has hit a record high of $1.337 trillion. And even though it appears to have hit a brick wall, something has changed because as the savings rate has tumbled, Americans still kept spending. And that was, of course, what wasn't expected because historically, what we see in cycles as credit cards get maxed out and savings rates get drained to zero, all of a sudden spending stops. But in the first quarter, it didn't. But now all of a sudden something has shifted and in a big way. But one thing that shouldn't be inexplicable is how you're making money in the market despite your friends seeing it go down. And let's review that big trade. This came back in March to our subscribers as of close. This is close of yesterday. You still see it's up double digits in wheat. Something most people don't even look at, but we flagged it to our subscribers even with videos. And that's what makes our services amazing because while most people can't figure out what direction the market is going or what to do, we give you signals no matter if the market's going up or down across a broad range of course sectors. Here you can see our CTA Timer Pro. This mimics a machine positioning. 81% win rate since March 11th. You bought every trade, you're 81% of them are in the green. Momentum Timer Pro, this trades our technical analysis. This up, now seeing 76% win rate, and it's really simple. One of them trades with machine positioning. We run a historical overlay to show you how to buy when the machines are at deep short positions so you can make money when they're buy. Our other report, it looks at the technicals that many people get wrong. They get in late, they get out early. We smooth it all out with a proprietary overlay, and you too can get that great win rate in your books. Links in the description below for a 30-day free trial. My friends make it pay for the first month, not us. Yet while it's easy to ensnare young Americans into installment debt, there's even a more sinister note to this extremely popular form of debt, which allows consumers to split purchases into smaller payments. And what they're referring to is these buy now, pay later, because what's really key about this is they don't report these loans to credit agencies. So you start to look back now, what happened as consumers were maxed out on their credit cards or getting close to it, which we were concerned about and mentioned on the show. Spending persisted because what you saw was a consumer shift to these pay in 4 plans, and that's simply because these companies aren't worried about if people are in debt and they don't report to the credit agencies, so they made money available in tons of it. And it's hard enough for central bankers and Wall Street to make sense of the post-pandemic economy based on the available data. Wells Fargo's senior economist is particularly spooked by the phantom debt that he can't see. And it's a problem for bankers, as you're about to see. The fact the recent explosion in installment debt may explain why the U.S. consumer remains so resilient, even when most conventional economic metrics suggest consumers should be struggling, which we agree with completely. Consumer spending in the world's largest economy has been so resilient in the face of stubbornly high inflation that economists and traders have repeatedly ripped up their forecast for slowing growth and interest rate cuts. But all of a sudden, something shifted here in the second quarter. And now what are we seeing from executives? In their earnings reports, they noted there was a demand slowdown, and now they're accelerating their buybacks, which is accelerating their exit plan of selling at the top. Now, this is important because a lot of people think, well, if there's companies are buying their stock back, then it means the market must go higher and higher. But remember, these are greasing the wheels of executives and board members who are very large shareholders that need to get out. So as a company buys, they're pushing the sell button. And yet cracks are starting to form. First, it was Americans falling behind on auto loans, as we talked about yesterday. The credit card delinquency rates reached the highest since 2012, with shares of debt 30, 60, and 90 days late, all on the upswing. And yet we continue to see spending. But now we know it didn't come from credit cards. It likely came from these buy now, pay later, and that is a huge problem. Again, it's not reported to credit agencies, so banks don't know. The challenge then will be consumers can pay on it? Well, we don't know, but certainly what we see here is the evidence suggests that they're not, because as we look at the net percentage of domestic banks tightening standards for credit cards, what we can see is in periods where banks do that, shown anytime the blue line is above the horizontal black line, which means banks restrict credit, they make new credit hard to get, they actually don't raise limits as much as people want. And what do you see the delinquency rate shown in red? It tends to go up with a lag, which makes perfect sense here. So as consumers were struggling with inflation, banks said, hey, look, we're not going to give you more margin on your credit cards. In fact, we're not even going to issue new debt, forcing consumers to turn to the buy now, pay later schemes. And well, that fueled a massive amount of spending going into the first quarter. But something's here now, as we see in the second quarter, changed in a big way. And there are signs that consumers are starting to struggle to afford their buy now, pay later debt too, as a recent survey conducted for Bloomberg found that a whopping 43% who owe money on these four-based services said they were behind on payments. So they barely just started making the payments and they're already behind. While 28% said they were delinquent on other debt because of spending on the platforms. So what they did is they shifted spending, went crazy on these buy now, pay later, and then ended up in delinquency on their credit cards and other debt because they can't afford it. And it makes good sense why. As we look at total compensation here against the delinquency rate, and we see total compensation in blue shown as averagely hours or earnings multiplied by average weekly hours of production and non-supervisory employees. And so what you would expect is that as you see a deceleration in total compensation, what happens is the delinquency rate in red goes up. Now, it doesn't happen every time. You might notice here in 2010 to 2012 it didn't occur. Why is that? Well, simple. It's because the Fed was at zero. I didn't highlight it here going to the dot-com bubble, but sure enough, you see that deceleration rise in delinquency rates. And we see it now. It's simple. Consumers just don't have enough money to pay on all their debts. We continue to make the case of why at some point the Fed is going to be back at zero. You can see it in multiple different ways. You see it in commercial real estate. You see it in subprime autos. You see it in, of course, buy now, pay later. Consumers are strapped. They're not keeping up at all. And yet the problem is they can't stop spending, but soon they're going to hit a wall. And why buy now, pay later is a black box largely because of long-standing blame game among providers in the three major credit bureaus. The companies that provide the data on their installment loans that are split into four payments, which are used by online shoppers to spend an estimated $19.2 billion in the first quarter, up 12.3% compared to the same period last year. So you can see here consumers are more and more turning to these buy now, pay laters. A lot of companies make it easy. You go to the register and it says you push a button. Do you want to pay over four? And the answer is, well, of course they do. The problem is that's encouraging more spending and in a bad way. And here you can see more than half the respondents who used the buy now, pay later said it allowed them to purchase more than they can afford, while nearly a quarter agreed with the statement that their spending was out of control. Again, at a time when total compensation growth continues to fall. In fact, the poll also found that 23% of users said they couldn't afford the majority of what they bought without splitting the payments, while more than a third turned to the services after maxing out their credit cards. And so this is something these big executives see in the data, that there's a sudden shift here and a change in the second quarter. We saw energy prices go up, and next thing you know, all of a sudden, we see in the survey data, we notice the services sector started to drop. They said demand fell. We see manufacturing, demand fell. And all of a sudden, out of nowhere, and you can see consumers hit a wall, and these executives want to get out before that next earnings report, because then all it gets revealed. And we can see that around the world as China's factory glut alarms the world that there's no quick fix, because everyone's focused on the fact that China is overproducing. What they're missing is its demand is not there. And China's trade partners, including friendly ones like Brazil, are also raising objections about all kinds of products lower down on the value chain, from steel and petrochemicals to excavators. In many of these areas, surplus emerged as unwarranted side effects of the real estate slump weighing down on China's economy. And yet Beijing hasn't figured out how to halt the slide yet, except by turning to high tech, so both sides of overproduction are set to persist. But again, it all comes back to, we look at the American consumer. We are the world's largest importing nation. And here we see tapped out on their credit cards, tapped out potential in these buy now, pay later, and at a point where their incomes are decelerating. And at some point, the spending has to drop, because the savings rates now are so low that people don't have cash in the bank either. And what's ultimately needed, and I love this, is a two-pronged approach to balance supply and demand, which involves stabilizing China's housing market and helping consumers spend more. Well, that is, of course, the answer, and it's not going to be higher interest rates to do it. But one of the things that everyone's afraid that China is going to do here is they're going to export deflation in a big, big way. Now, in U.S., we export inflation through dollars. China exports deflation as we see prices go down here. Looking at the producer price index, this for industrial activities total for China, that in red against the U.S. consumer price index. And you can see very clearly that deflationary pressures out of China. Anytime that red line's below the horizontal black line suggests that U.S. consumer prices are not indeed going higher, as everyone expects they're going to. So the reality here is China's factories continue to overproduce and they don't have buyers. Well, it means deflation's coming. That means demand's going down. And again, it all comes back to, what do these executives know? They already know spending is drying up, and quickly. And right now, far from being ready to shoulder more of the burden of growth, China's households and local governments are tightening their belts after the housing crash, just as I suggested they would. With weak domestic demand, the industrial capacity utilization rate dropped last quarter to the lowest since the pandemic hit by early 2020. And factories are pivoting to overseas markets, exports have soared, and prices are plunged, exactly as we predicted would happen months ago, that China would export deflation around the world. And since everything to do with a weaker yuan, a stronger dollar here, we're going to see a shift of production to China, because if they don't turn their capacity utilization rate around, it means bad things are coming for their economy. The problem is, as work leaves U.S. factories and goes overseas due to the currency mismatches, well, it means activity here in terms of utilization in our factories, it's always going down, and that doesn't bode well. As we look at the U.S. data here, capacity utilization that's shown in blue against continued unemployment claims. And if you notice, it looks virtually like a mirror of each other. Well, that's because they are. And so what you see as demand for factories goes down in terms of the percentage of the factory that's being utilized, that means more and more people hit the unemployment line. And China is trying to stave that off in a big, big way. The problem is they're going to flood the world economy with cheap goods, and then next thing you know, we're going to see deflationary pressures, and then the layoffs hit in a big way. In fact, we're starting now to see them, and I want you to notice how the news spins this. As U.S. jobless claims jump in a week when New York schools had a break, of course, had nothing to do with the economy, but just one state. As initial claims increased by 22,000 to 231,000 in the week ending May 4th. The median forecast said, well, should be right around that 212 number that's been consistent for months, because New York public school workers such as bus drivers are allowed to apply for benefits during the winter and spring breaks, which tend to boost weekly claims numbers. And while resilient demand, which we're arguing has now shifted, is making companies reluctant to dismiss workers, the latest monthly jobs report showed a moderation in hiring. Yet the labor market has largely outperformed expectations over the last year and powered the economy. And while demand here may remain resilient, I don't think it lasts for long, because while companies certainly aren't looking to lay people off, they're also not hiring. As we see, continued claims of proxy for the number of people receiving unemployment benefits rose by the most in a month to 1.79 million, showing that people on unemployment cannot find a job. But the market looks at this and says, well, it's no big deal. But I want you to understand, we went from a very overheated, highly fiscal and monetary stimulated global economy to now, when you look at history, it says, well, in 20 years that preceded the pandemic, claims were averaged around 345,000, and continued claims were roughly 2.9 million, suggesting, well, there's nothing wrong. Well, the issue is it's a matter of where we come off the bottoms here. So even though 1.8 million historically seems low in an overheated economy, it starts to have a big effect. And what this means for central bankers, well, it means cuts are coming. As Bailey signals the Bank of England may cut rates more quickly than expected, and we'll hear that eventually from the Fed as well, it's likely we will need to cut bank rates over the coming quarters and make monetary policy somewhat less restrictive over the forecast period, possibly more so than currently priced into market rates, and simply because they're seeing their economy slow down too. We're seeing it here in the US, we're seeing it happen in China, we're seeing it in other parts of Europe, and all of this means is these executives at the top that instituted these large buybacks, it was all done for them to sell their shares, the other executives and the board members to get out while we're at the top, while everyone continues to pile in. What they're calling the top of the market. Well, what do you think? Love to hear from you. Weigh in the comments below. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.